Hello everyone, welcome to your CPA School. Today we begin our journey into stockholders equity, the architecture of ownership. Think of this structure as the foundation of corporate finance. Assets from the top, liabilities support the middle, and what remains, the residual interest, belongs to the owners. This equation, assets minus liabilities equals stockholders equity, captures the essence of ownership. It is not just a formula, it is blueprint of how value is built and claimed within a corporation. Stockholders equity tells the story of ownership. Who invested, what was earned, what was retained, and what was returned. Throughout this session, we will follow that story from capital contribution to retained earnings, accumulated other comprehensive income, and treasury stock. Let's explore how each layer contributes to that ownership story. And hey, if you enjoy learning with clear visual explanations, make sure you like, subscribe, and hit the bell icon so you will know when the next Farmaster series module drops. Also share this with your colleagues or friends who are preparing for the CPA exam. Learning together makes the journey way easier. Alright, let's dive in. Now that we have seen the architecture of ownership, let's break down the stockholders' equity really means. It's the owner's claim to the net assets of a corporation. What remains after all liabilities are deducted. That's why we call it the residual interest. Think of it as the foundation value of the business. It represents the company's net worth, reflects the owner's investment and accumulated earnings, and provides a cushion of financial security for creditors. In this example, if total assets are 1 million and liabilities are 600,000, the remaining 400,000 is the owner's equity. They are a stake in the company's value. So every time you see the equation assets minus liabilities equals equity, remember it is not just math. It is the story of ownership and value creation. Now that we have seen the pillars of equity, let's look at how those pillars break down into specific parts. At the base, we have capital stock, also called legal capital. These represent the amount invested by shareholders when they purchase shares, the foundation of ownership. Above that is additional paid-in capital, which captures any excess amount investors pay over the stock's par value. Together, these two form contributed capital. Next comes retained earnings, the accumulated profits that the company has earned and kept rather than distributed as dividends. This is the engine of growth within equity. Then we have accumulated other comprehensive income, items like unrealized gains or losses that bypass net income but still affect total equity. So each layer builds upon the previous one, from shareholder investment to earned value, forming the complete structure of ownership. And here is a golden rule. Elements must be clearly classified in the financial statements according to source. Let's walk through the building blocks of equity layer by layer. The blue base block represents capital stock, legal capital, the foundation of ownership contributed by shareholders. Above it, the green block shows additional paid-in capital, the excess amount investors pay over par value. The gold block stands for retained earnings, accumulated profits retained in the business. The purple block depicts accumulated other comprehensive income, unrealized gains and losses that bypass in net income. Finally, the red top block represents treasury stock, a contra equity account for shares repurchased by the company, reducing total equity. The stacked design emphasizes how each layer builds upon the previous one, forming the complete structure of a stockholder's equity, from initial investment to retained value and adjustment. So when you look at this structure, remember equity is not just number. It is the evolving story of ownership. Let's look at the navigation map, the blueprint of a stockholder's equity. It helps us visualize how equity is structured and classified. We start with contributed capital, which includes capital stock, the legal capital represented by par value and number of shares, and APIC, additional paid-in capital, the excess contributed by shareholders above par. Next, we move to earned capital, which grows from operation. It includes retained earnings, the accumulated profits after dividends, and accumulated other comprehensive income, which captures non-owner changes like unrealized gains, foreign currency translation, and pension adjustment. Finally, we have Contra Equity, represented by Treasury stock. Shares repurchased by the company, reducing total equity. Together, these five panels form the complete architecture of equity, showing how ownership evolves through contribution, performance, and corporate actions. Here we see the trinity of shares, the three essential categories that define a corporation's share structure. At the outer layer are authorized shares, the maximum number of shares that the company is legally permitted to issue under its charter. Within that, we have issued shares, which represent the portion of authorized shares that have actually been sold or distributed to shareholders. And at the core are outstanding shares. The shares currently held by investors. These are the ones that carry voting rights and receive dividends. It is important to note that disclosure of all three categories, authorized, issued, and outstanding, is mandatory. This transparency helps users of financial statements understand the company's capital capacity and ownership distribution. This session begins with the foundation of ownership, common stock. It is called the bedrock because everything in a stockholder's equity built upon it. Common stock represents basic ownership, voting rights, and residual claim on assets after all liabilities and preferred interests are settled. In this discussion, we will explore how common stock forms the core of contributed capital, how it is issued, valued, and presented in the financial statement, the true starting point of equity. Common stock represents the basic ownership interest in a corporation. Holders of common shares carry the highest risks because they are last in line during liquidation, but they also have the highest potential reward when the company prospers. They enjoy rights such as voting right, power, the ability to receive dividends when declared, and a residual claim on assets after creditors and preferred shareholders are paid. In addition, common shareholders often hold a preemptive right, meaning they can maintain their ownership percentage if new shares are issued. In short, common stockholders are the true owners of the company. They take on the greatest uncertainty, but they stand to benefit the most when the business succeeds. Accounting journal. Here's how we record the first equity transactions. Shares issued at par. ABC company issued 50,000 shares at $20 each, matching the par value. The entry is straightforward. Debit cash for 1 million and credit common stock for 1 million. Notice that there is no additional paid-in capital here because the shares were issued exactly at par. This forms the foundation of understanding later scenario when shares are issued above or below par. Clear? Accounting journal. Here we see how to record shares issued above par. ABC company issued 50,000 shares at $25 each, generating 1.25 million in cash. The par value portion, $20 per share, goes to the common stock account, totaling 1 million. The extra $5 shares of 250,000 in total is credited to additional paid-in capital. This entry shows how equity expands beyond the par value. The premium investors pay becomes part of contributed capital, strengthening the company's financial position. If you look clearly, you can see it is the transaction date and cash account debited by the full amount means 25 times 50,000 common stock, 50,000 shares times par value. Common stock always credited with the par value, and above the par value, we always credited additional paid-in capital. So what's the amount? Each share, the exchange of par value is 5. So for 50,000 shares, the amount is 250,000. 5 times 50,000. Clear? Accounting journal. Here's how we record shares issued at a discount. ABC company issued 10,000 shares at $15 each. While the par value is $20, the company receives 150,000 in cash, right? 150,000, but the total par value of the shares 200,000. The 50,000 difference is recorded as a discount on issue of shares, which reduces total equity. This entry highlights that issue shares below par is generally discouraged because it weakens the company's capital base. However, it's shown here for conceptual understanding to illustrate how the journal entry would look if such a transaction occurred. Let's look at how to allocate a lump sum purchase between different classes of stock. RIA Corporation issues 1,000 common stock and 2,000 preferred stock for a lump sum of $80,000. Market price, common stock at 36 and preferred stock at 27 each. So what is our duty? Duty, we need to split these 80,000 or allocate this 80,000 to common stock and preferred stock. So how much we give you the common stock, how much we give you the preferred stock. So as the market price of two classes of transactions are different, so we use relative market price value. So our first step to calculate the fair market value. So fair market value of the shares. So 1,000 shares, $36 per share. So common stock 1,000 times 36, 36,000. Preferred stock 2,000 and market price 27. So 2,000 times 27 equal to 54,000. So total fair market value is 90,000. Right? Right. The determined ratio, common stock and preferred stock. So 36,000 is the common stock out of 90,000. So 36K divided by 90 equal to 40% for common stock. And 54K, 54K divided by 90K, 60% for preferred stock. The total cash received 80,000, right? 60% of 80,000 equal to 48,000 allocated to preferred stock. And the remainder is 32,000. 80 minus 48, 32,000 or 40% of 80,000, 32,000 allocated to common stock. Okay. Now we move to preferred stock, often called the hybrid security. It's termed hybrid because it combines features of both equity and debt. Preferred shareholders have ownership like common shareholders, but they also enjoy fixed dividend rights similar to bondholders. In this section, we will explore why preferred stock sits between debt and equity, how it offers priority in dividends and liquidation, yet limits voting rights. This balance makes it a unique instrument in corporate finance. Preferred stock carries a special privilege that distinguishes it from common stock. Each feature defines how investors and issuers interact, and several features can coexist within a single issue. Let's start with the dividend feature. Cumulative. If dividends are missed, they accumulate and must be paid before any common dividends. Next, the conversion feature. Convertible. This allows preferred shares to be exchanged for a specified number of common shares, offering flexibility and potential upside. Then comes the participation features. Participating, these shareholders can share in additional dividends with common shareholders once preferred dividends are satisfied. Finally, the redemption feature. Callable. The issuer can redeem the shares at a predetermined price under the terms of the issue. Remember the CPA team. These classifications are independent. A single preferred stock can be cumulative, convertible, participating, and callable all at once. Understanding these combinations is a key to analyzing equity instruments. Let's look at how dividends flow when cumulative preferred stock is involved. Out of the 44,000 declared, the first priority goes to clearing arrears 12,000 owed from prior years. Next, the current year's preference of 24,000 is paid. That totals 36,000 to preferred shareholders. Only the remaining 8,000 flows to common shareholders. This waterfall shows the hierarchy clearly. Cumulative preferred stockholders always receive their due first, ensuring their dividends rights are fully honored before any distribution to common stock. Let's clarify a common misconception about dividends in arrears. The golden rule is that dividends are never recorded as a liability until the board of directors formally declares them. In this example, Apex company has cumulative preferred stock. We calculate the arrears. Year 2 accumulation 15,000. Year 3 accumulation 15,000. Altogether 30,000. Less payment made in year 3 10,000. That leaves 20,000 in total arrears. However, since these divisions have not been declared, they are not accrued as a liability. Instead, they are disclosed in the financial statement footnotes as shown here to inform users that preferred shareholders are owed dividends but not yet entitled to payment. So remember, disclosure is okay, accrued liability is not okay. This distinction is critical for proper presentation under US GAAP. Participating preferred stock gives preferred shareholders an extra advantage. They not only receive their fixed dividend but also share in additional dividends with common shareholders when profits exceed a certain level. Let's break down the three stages shown here. Stage 1, preference. Preferred shareholders receive their guaranteed dividend first. That's their priority. Stage 2, the match. Common shareholders then receive dividends equal to the preferred amount, creating parity between both classes. Stage 3, participation. When there are excess dividends beyond that point, both preferred and common shareholders share proportionately in those extra earnings. So participating preferred stock combines the security of preference with the potential for growth. It rewards preferred shareholders when the company performs exceptionally well. Let's walk through how dividends are distributed when a company has cumulative fully participated preferred stock. In this example, a company with 8% cumulative fully participating preferred stock declares 101,000 in dividends after skipping the prior year's dividend. The company has 250K of preferred stock and 500K of common stock. So total dividends full how much? 101,000. So what is the preferred dividend stock dividend? 250K is the preferred stock capital times 8%. So 20,000. So prior year's dividend 20,000. Subtract 20,000 for the first prior year, then it comes 81,000. Then the current year dividend again the similar amount 8% of 250K 20,000. So after 20,000 it comes 61,000. So we see the preferred shareholder get 20 plus 20 40,000. So here is the matching. So we need to pay 40,000 to the common stockholders first. So from 61 we pay 40,000 to the common stockholders. Then 21,000 is the excess after matching both the group preferred and shareholder. So 21,000 should be divided among preferred stock and common stock in their proportionate ratio, in their proportionate capital. So 250K or 500K, the proportion is 1:2. So 1:2. So 1 plus 2 equal to 3. So this 21,000 divided by 3. So 7,000. This 7,000 goes to the preferred stock and 14,000 goes to the common stock. So what is the final result? Preferred stockholder receive 47,000, common stockholder receive 54,000. Clear? So this test illustrates how participation allows preferred shareholders to share in extra dividends once their fixed preference and matching amounts are satisfied. Additional paid-in capital, often abbreviated as APIC. This represents the amount shareholders pay above the par or stated value of shares. It's the premium received by the company, a key component of contributed capital. APIC reflects investor confidence. When shares are issued above par, that excess becomes part of equity, but not part of the legal capital. In the next slides, we will see how APIC is recorded, adjusted, and presented in the Stockholders Equity section. Let's look at how additional capital, paid-in capital or APIC works. It represents the overflow of capital received from shareholders beyond the stock par value. Imagine the par value as the legal minimum, the small container here. When investors pay more than that the amount, the excess flow into the larger container, right? That's the APIC. The formula is simple. Number of shares issued times contributed capital minus par value. APIC grows from several sources: a stock issued above par value, reissuance of treasury stock above cost, conversion of bonds or preferred stock into common shares when stock options or warrants are exercised. So, APIC captures the company's capital surplus, the extra value shareholders contribute beyond the legal capital. It's a key part of contributed equity and reflects investor confidence in the company's worth. Basic Accounting Journal. When a company issues shares above par value, we record the total cash received as a debit to cash. The par value portion is credited to common stock. This represents the legal capital. The remaining amount, the premium investors pay above par, goes to additional paid-in capital. This entry shows how equity expands through both par value and additional paid-in capital. Together, they form the contributed capital section of a stockholder's equity. Now we move to retained earnings, the engine of internal growth. It represents the portion of net income that a company gives rather than distributing as dividends. It is essentially the accumulated profits that's reinvested into the business, used for expansion, debt reduction, or strengthening equity. Think of retained earnings as the company's internal source of financing. Each year, it increases with profits and decreases when dividends are declared or losses occur. In short, retained earnings tell the story of how much value the company has built and kept over time, a key indicator of long-term financial health. Retained earnings act as the engine that powers a company's accumulated wealth. They represent the total profits kept in the business after dividends are distributed, the portion reinvested for growth, stability, or debt reduction. As shown here, net income flows into retained earnings, increasing the balance. From that pool, the company may distribute cash dividends, property dividends, or stock dividends, which reduce retained earnings. The formula is straightforward. Ending retained earnings equals to beginning retained earnings plus net income minus dividends. Adjustment for prior periods may also be included when necessary. If retained earnings turn negative, it is called a deficit, a signal that cumulative losses have exceeded profits. And remember, retained earnings exclude treasury stock and accumulated other comprehensive income. It focuses purely on earned profits retained within the company. Appropriations, locking the earnings. Appropriation represents a way to lock part of retained earnings, signaling that certain amounts are not available for dividends. They serve as a disclosure, not a cash reserve, showing management's or contractual restrictions on how retained earnings can be used. There are two main types: legal or contractual appropriation, such as those required by debt covenants; discretionary appropriations, made voluntarily for purposes like plant expansion or future projects. It's important to note that appropriations do not set aside cash, they simply reclassify equity within retained earnings. The journal entry is straightforward. Debit retained earnings unappropriated. Credit retained earnings appropriated. This shift part of the balance into a restricted category. In essence, appropriations communicate transparency. They show stakeholders that some profits are earmarked for a specific commitment rather than dividend distribution. Here we compare two types of restrictions. One affects equity, the other affects assets. On the left, appropriated retained earnings simply reclassify part of equity to show that it is reserved for future projects. There is no cash movement. It is a bookkeeping adjustment. On the right, sinking fund cash represents an actual restriction on physical cash, money set aside for a specific purpose, like retiring bonds. This impacts liquidity but not equity classification. In short, appropriations lock earnings conceptually, while sinking funds lock cash physically. Understanding this distinction helps clarify how companies manage both their capital structure and liquidity. Now we move to accumulated other comprehensive income, often abbreviated as AOCI. This represents the cumulative total of unrealized gains and losses that bypass the net income statement. Items like foreign currency translation adjustment, unrealized gains or losses on available for sale securities, and pension plan adjustment. Think of AOCI as the equity reservoir for all those changes in value that haven't yet been realized. It's part of the comprehensive income, but not part of net income. In the next slide, we will break down each component and see how AOCI connects to the statement of comprehensive income. Think of accumulated other comprehensive income or AOCI as a parking lot for certain gains and losses that bypass the income statement. These items are recognized in the current period but excluded from net income. Instead, they accumulate in a stockholders' equity as part of AOCI. The acronym PAF helps us remember the four key components. P stands for pension adjustment, U stands for unrealized gains or losses on available for sale debt securities, F stands for foreign currency translation adjustments, E stands for effective portion of cash flow hedge. Each of these items flow into AOCI until realized, at which point they move out and affect net income. The formula ties it together. Beginning AOCI plus minus current OCI equal to ending AOCI. So, AOCI acts as a holding area, capturing unrealized changes that still influence equity, even though they haven't yet touched the income statement. Now we move into treasury stock, an important concept in stockholders' equity. Treasury stock represents shares that were once issued and outstanding but later repurchased by the corporation. It's a contra equity account, meaning it reduces total stockholders' equity rather than being treated as an asset. We will explore why companies buy back their own shares and the methods used for accounting. Let's dive in. Let's begin with the concept of treasury stock. When a corporation buys back its own shares from the public market, those shares become treasury stock. This action represents a return of capital to shareholders. The company is essentially investing in itself. Treasury stock is not an asset. It's shown as a direct reduction in the stockholders' equity. These shares are issued but no longer outstanding, meaning they don't carry voting rights or receive dividends. The illustration here shows how cash flowing from the market back to the corporation. A simple way to visualize how buybacks reduce equity while consolidating ownership. Let's look at how treasury stock is accounted for. Most companies use the cost method, where the reacquisition cost becomes the basis for recording. A smaller number use the par value method, which removes the original APIC and records the shares at par. Regardless of the method, remember the golden rule. Treasury stock transaction never touch the income statement. Any gain or loss is treated as an equity adjustment, not as profit or expense. This distinction is crucial because it preserves the integrity of net income while showing how buybacks and reissuance reshape the equity section. This dashboard brings together everything we have learned about stockholders' equity. On the left, we have contributed capital, funds invested by owners. In the center, earned capital, value generated through business performance. And on the right, contra equity, treasury stock, which reduces total equity. Notice how each section connects to the CPA exam golden rules at the bottom. These rules summarize the essence of equity accounting. Contributions build equity, performance grows it, and repurchase reduce it. This slide serves as your master map, the complete framework of corporate ownership. Here's how everything we have discussed comes together in financial reporting. This consolidated statement for Capital Corp shows the five building blocks of a stockholders' equity. At the top, we see capital stock, the par value of shares issued, representing the initial investment. Next, additional paid-in capital, the overflow beyond par, plus other shareholder contributions. Then retained earnings, profits accumulated and reinvested. Below that, accumulated other comprehensive income, unrealized gains and losses that bypass net income. Finally, treasury stock, shares repurchased shown as a deduction. Together, these components form total stockholders' equity, the residual ownership interest after liabilities. This slide is the bridge between concept and reporting, the moment where theory meets the balance sheet. Stockholders' equity tells the story of ownership: who invested, what was earned, what was retained, and what was returned. Understanding this story is the key to mastering stockholders' equity for the CPA exam and for professional accounting practice. Thank you for joining me in this session of the FAR Master series. I hope today's walkthrough of stockholders' equity helped you see how ownership, capital, and performance connect in one elegant structure. If you found this lesson valuable, please like, share, and subscribe. And don't forget to press the bell icon so you are notified when the next module drops. Remember, concept first, confidence always. See you in the next FAR Master series module.